With us today is Mark Slater, Head of Slater Investments and Manager of the MFM Slater Growth Fund. Thanks for talking to us, Mark.
Pleasure.
How would you characterise the investment style of your fund?
We're targeting companies which can grow at an above average rate, which we can buy relatively cheaply. And I would say the key thing for us is that those businesses benefit from some kind of tailwind. So in other words, we want cheap growth, and we want it to continue for as long as possible.
Now your fund is a top growth fund over 1 and 5 years. I think returning approximately 220% over 5 years according to LIPA. To what do you attribute this outstanding performance?
I think the key thing was good stock selection. There's no particular sector theme that's benefited us. We've done a good job in selecting good companies. I'd say what we tend to find is over a typical 5-year period, we'll often get 1 year which is less good, and the other 4 would be pretty good. So although we've done very well over 5 years, within that period there was a period of underperformance in 2012. That was when cyclical stocks were particularly strong, and that's a part of the market that doesn't really suit us. But these things even out. So over 5 years we've done very well, and over a shorter, over 1 year we've done also very well.
What are the main criteria that you look for in a prospective investment?
Well, we start off in a very quantitative way, and then as we go through our process we become very qualitative. So at the wide end of the funnel, we're screening the market for companies which exhibit good levels of earnings growth, and at the very wide end of the funnel we work from the consensus of brokers' forecasts. We're looking to buy those companies cheaply, and our sort of quick and dirty measure for that is the PEG, which is a very good measure of growth companies. When the numbers are within the normal range, then it's a very powerful measure. Cash flow is very powerful as well. It's a very good sanity check on profit, on the quality of profit. And companies that pass those basic tests, we then look at in a lot of detail, more qualitatively. And the key question we're asking ourselves at that point is, what is going to drive the growth? The key with the growth business is that the growth is reliable. It has to be delivered. So what we're after there is something fairly tangible that will drive growth, an identifiable tailwind. But ultimately, really it's about the nature of a business. So one has to lift up the bonnet and have a good look around.
After 5 years of a bull market, are you seeing much value out there?
I'd say the short answer is yes. The long answer is that it ebbs and flows. So for instance, this year, I'd say at the very beginning of 2014, it was very hard to find value. Then you had a pretty sharp correction, particularly in the tech part of the market, and also the mid and small cap part of the market over the next few months, from sort of February until March, or probably until May actually. And in that time, a lot of stocks fell 20, 25, 30%. Good companies. There were some bad companies that fell a lot more. So although it was difficult at the beginning of the year, then it became quite easy. Similarly, in more recent times, coming in the sort of early part of September, it was getting hard again. Markets were getting up to their highs. And then there was a very short, sharp shock from the sort of back end of September through to the early part of October, when again markets fell about 10%. And within that average, you had a lot of smaller and medium-sized companies falling very sharply. So again, in that period, we went shopping. Very often we find when it starts to get quite difficult, the thing is you hold back and the value will come to you, normally.
So you've established some new positions?
Yes, quite a number. We added to a lot of existing positions, and we established 1 or 2 new positions as well, yes.
Could you tell me something about a couple of the new positions?
Well, one company we bought into during that period was Lion Trust, the asset manager. And Lion Trust we bought into very cheaply. The shares had come down from, I forget the high, but they must have been at least 20% off their high. There were 1 or 2 big sellers depressing the price, and we basically came in on a clear up and bought the shares very cheaply. We were paying about 11 times March 2015 profits, earnings rather, and a multiple of about 8 times the following year's earnings. So very low rating, very good growth, good visibility, very strong balance sheet, lots of net cash. So just ticked all the boxes for us.
And any others that you get at all?
We added to quite a lot of existing positions. One was Restore. They did a financing in October. Very attractive. Well, this is a company we've owned for many years,
right.
but and we've supported a number of financings over the years. In October, they made an acquisition of a competitor, and it makes them the clear number 2 in their space. What we like about Restore is it's a very good combination of pretty reliable organic growth, because the average customer, for instance a law firm, will generate new boxes that will be equivalent to between 5 and 10% organic growth every year. On top of that, the company's been very successful in making acquisitions of small competitors normally. This was actually a large competitor they bought. These are very low risk deals because they're just buying, building sheds with a few contracts. They're low risk acquisitions, lots of savings that they can implement day one. And those acquisitions typically take the growth rate up into the sort of 20-25% ballpark, so very attractive. The Restore deal was 15% earnings enhancing, and that's despite the fact they issued some equity. So we were paying about 13 times next year's earnings for a business growing at 20-25%, which we know well. So very, very attractive terms. Another one we were buying in that period is again a long-standing holding of ours called First Derivatives. They're originally an Irish business. It's an IT consultancy, and they also have a very strong software offering. Business is growing in the sort of 20% type ballpark. What we like about that company is that there's the growth, there's lots of good visibility in terms of forward growth. There's also a potential moonshot that one's not really paying for. If they're successful in continuing to sell their software to larger customers, and they've already sold done one or two very big deals, if that continues, there's a very good chance of dramatic upgrades, but of an order of magnitude that would quite literally change the company. These are potentially transformational contracts that they're looking to sign, selling their software. If that doesn't happen, you've still got a very nice business. So it's a very good risk reward. We were buying shares during the flash crash in October at around £9.30. They had been quite a lot higher. Even there, the earnings multiple was about 20, so quite high. But because there have been upgrades, which aren't fully in the numbers yet, but there have been a number of upgrades. So it's about 20 times at that price. They've done very well since, actually, so they've recovered very, very strongly. Another one was Pressure Technology, which is a company we've owned for quite a long time. We came back a bit during this period, and we topped those up. So we've been quite active.
I can see, thank you. What piece of advice would you offer to an everyday investor trying to make money from the stock market?
Private investors have a number of advantages, and so they have to make sure they use them. And I think the single biggest advantage they have is that they can concentrate their portfolio. One can concentrate and be quite safe. So I think they ought to concentrate on their best ideas, perhaps have 5 holdings, that kind of thing. That would be the first thing. And focus on exceptional companies. So I would argue they shouldn't speculate. There's no need to. They should have significant holdings in companies where they have very high conviction and for good reasons. They should ignore the noise. There's lots of noise in markets. Most of it's unhelpful. And they should run their profits and cut their losses. That's what always works. And they should be tax efficient. There are a lot of tax advantageous ways of investing, particularly with ISAs and SIPs, and they should make full use of that kind of thing. But the key, I think, is to invest. It's to invest rather than speculate, and to be heavily invested in very high quality businesses that they understand well.
That sounds like great advice, definitely.
Well, it also sounds quite trite in the sense that it's it sounds very simple, but it's not.
And in terms of an accessible book that an investor should definitely read, are there any that you'd care to recommend?
Well, I mean, I'd have to mention my father's books. They're both the Zulu Principle and Beyond the Zulu Principle have stood the test of time. They're both still very good, and I mean the principles there are extremely powerful. And they're both very well explained books. They're very accessible to anybody. One doesn't have to be particularly mathematically orientated to understand them well. A book I really enjoyed more recently, which is superb actually, is The Outsiders, which is a book by a guy called William Thorndike. It was actually recommended, Buffett recommended it in 2012 as the best book he'd read that year. It's a very interesting book about 8 American chief executives and about what makes them good and what makes the businesses they run good. So it's quite different, but it's less of a practical book about investing. It was just interesting. But I think the Zulu Principle and Beyond the Zulu Principle are very hard to beat in terms of a practical guide, in terms of what to actually do.
Well, thank you very much, and thank you for joining us.
Pleasure.